Okay class, this is part 2 of our chapter 5 video lecture. Let me discuss a couple topics that I should have mentioned in the previous part 1 video. All of the assets we're buying and selling assumes that we're not in a retirement account. So examples of retirement accounts would be things like individual retirement accounts, either a so-called traditional or a Roth type, or something called well, 401k plans, either traditional or Roth. And for self-employed individuals, there's something called a KEO plan. So here's the retirement plan, and we make contributions into the plan. And this contribution possibly is a deduction, maybe not, but you get taxed not when you buy or sell stock here, but when you take a distribution from the plan, a withdrawal. So if you have a gain realized here or loss realized in the buying and selling of investments, of capital assets, the gain and loss is realized but not recognized. And again, any gain, any taxable income is going to be recognized at the time you withdraw the distribution from the retirement account. And we'll talk about retirement accounts in a future chapter this semester. Let's talk about holding period again. So if you remember, to be able to get a long-term gain or loss, you have to have held the asset for more than 1 year before you sell it, before you get rid of it. Or sometimes they'll say at least holding it for 1 year and 1 more day. So that makes it more than a year. Maybe it's easier to illustrate this using a timeline, and the easiest dates to maybe report on a timeline is the beginning of the year. So let's say January 1st, 2017. And here at the end of the calendar year, December 31st, 2017. And here is the seller on this date, and you're going to be the buyer. To keep things simple, maybe this is stock. The seller is selling and you're buying on New Year's Day, January 1st. And you want to report the sale as a long-term gain, right? So you get taxed at lower rates. So you have to hold it for more than a year. So let's say you sell it right here on December 31st. You're going to be the seller at that point, and then someone else is going to buy it from you. So tell me, how long have you held this asset before you sold it? Did you hold it for a year? Well, on the date the property is exchanged, the seller is considered to have owned it the whole day, and you, the buyer, really don't own it until the next day, or January 2nd, 2017. And if you sell it on December 31st, you, the seller, owns it on that day, and the buyer will take over on the very next day. So you know from the 2nd, January 2nd through December 31st, that's not more than a year. So this sale here will be short term. So let's change the date here. We'll keep the purchase date, January 1st, but then we'll sell it, not here at the end of the year, but the next day, January 1st, 2018. So now, have you held the property for more than a year? You bought it on January 1st. Well, I shouldn't say you bought it. It exchanged on January 1st. But again, you're still not considered to have bought it until the very next day or owned it the very next day. So from January 2nd through January 1st of the next year, is that more than a year? In fact, that's exactly 1 year, right? Equal to 1 year. The rule is has to be more than a year. So if you bought it on January 1st, when's the first day you can sell it to make it long term? Should be January 2nd, 2018. Remember, even though you think you bought it here, it's still owned by the seller on the 1st, so you own it on the 2nd. The 2nd through the 2nd of that same month next year is 1 year and 1 day. If you sell it on the 1st of the next year, that's exactly 1 year. Yeah, from the 2nd through the 1st is 1 year of the following year. Okay, so watch out if it gets close to the 1 year period. I would actually draw out a calendar like this to make sure whether it's long term or not. Another topic about maybe not selling an asset, but when it turns worthless during the year. You always have to look at the date of sale, but if there is no sale and the stock is worthless, what you got to do is take a look at the value of that asset at the end of the year and determine whether it is worth zero. If it is not worth zero, then you're still considered to have an asset that has a value and you cannot take any loss at all. Only when it turns to zero by the end of the year, you can report a loss for whatever cost basis you can subtract in calculating the loss. Again, you got to look at the end of the year. So if a company goes bankrupt during the year and you're not going to get anything in return, you still got to wait to the end of the year and see if there is anything there. And if not, then you can claim the loss for the year. If you think there's still some value there, even $1, the stock is not yet worthless. So you have to wait again another year to see if you're going to get something in exchange or nothing. Again, worthlessness is determined at the end of the year, December 31st for most people. If you have a long-term capital gain, if you have what we call qualified dividends, like we learned back in chapter 3, they get taxed at lower rates than the regular rates of the taxpayer. So these are the lower rates. So let's take a look at a tax rate schedule. Here, this is for 2017 for a single filing status individual. And what you would do is look up the taxable income in these ranges of amounts here. This taxable income includes the qualified dividends that get taxed at the lower rates. They include the long-term capital gains that get taxed at the lower rates. Okay, so this is a relatively high amount of taxable income that you're looking in these ranges. And if your taxable income falls within the 10% or the 15%, or in other words, the taxable income is less than this, the long-term capital gain and the qualified dividend tax rates are going to be, for these two ranges now, it's going to be zero. In other words, tax-free long-term capital gain, really net long-term capital gain. And qualified dividends tax also at zero. Again, if your taxable income is less than this for a single filing status for the year 2017. Now, if your filing taxable income falls within these four ranges here, the tax rate is going to be that 15% amount for the long-term capital gains and qualified dividends. And if your taxable income exceeds this, and again it includes the qualified dividends and long-term capital gains, exceeds this rate, then your net long-term capital gains and qualified dividends will be taxed at 20%. 0, 15, 20 for net long-term capital gains and qualified dividends. Our textbook calls it sometimes net capital gains or adjusted net capital gains for these rates here. Now there are certain types of capital gains that are going to be taxed at different rates than these here. Um, Maybe I'll show you an example of this unrecaptured Section 1250 gain. Whatever that gain is, that's going to be taxed at, and collectible, and this stock gain is going to be taxed at whatever rate you fall within for that taxable income. But once you exceed a certain limit, those gains, these gains here, will have a max, yeah, these are maximum rates of 25% or 28%. The Section 1250 unrecaptured gain, it deals with depreciation. Recaptured means that you're going to turn the gain into ordinary income tax at regular rates. Unrecaptured is going to be treated as a capital gain, but subject to a maximum rate of 25% if that depreciation again was not turned into ordinary, not recaptured. Collectible gains, if you think about collections, a stamp collection, antique automobiles, maybe jewelry. This definitely includes also gold bullion like coins. When you sell them, it is a capital gain and it's going to be taxed at regular rates up to a maximum rate of 28%. And this type of gain, stock gain, is also maximum rate of 28%. So these are the general long-term capital gains, and these are for long-term capital gains falling to these classifications. This is kind of a flow chart of how to group and calculate eventually the gains. But let's take a look at really the tax forms to kind of see how these numbers are flowing. But first, here's really a summary of some of the issues, yeah, in our chapter 5. In terms of making sure you have proper documentation, things like receipts, cancel checks, bank transfers, you gotta keep all of that as long as you own the underlying asset, and maybe another 7 years after that when you get rid of the asset. If you own a property for the past 20 years and still own it, you still should have the documentation for purchasing it for whatever basis you're going to be claiming eventually when you get rid of it. Let's take a look at the forms to report capital gains. First off is our old 1040 form, Form 1040. And of course, here we've seen the different types of income that we reported, we learned back in chapter 3. One of which is this qualified dividends that's included here in ordinary, but the qualified dividends are separated so we can be taxing this eventually at the lower rates, that 0, 15, or 20%. The topic of our chapter 5 is capital gains. So all of that is first summarized on Schedule D and put here as a total. If it's a positive amount, we're probably going to be taxing some of this at a lower rate than the other income. If you end up with a loss, the maximum loss here in line 13 would be $3,000 that you can offset the other income being reported here. If you have any excess loss beyond the 3,000 for the year, you're going to carry it over to next year to offset next year's capital gains. And if you still have more left over, then another 3,000 here to offset the other income. Let me back up here to line 12, well, down here to line 14. Other gains, not capital gains, but this other gains is from the sale of business assets like business equipment, a business building. And if you had depreciated the property, possibly the depreciation will be treated, at least to the extent of the gain, as ordinary income here added with the other income, and not taxed as a capital gain income taxed at lower rates. That's reported on Form 4797 that I'll show you at the end of this Part 2 slideshow. But let's, well, this is Schedule D. We'll take a look at Schedule D. But first, just adding down all the income, minusing out any adjustment deductions here at the bottom of page 1 of the 1040, and then at the top of the next page, this is our AGI. Let me zoom in here. Subtracting out deductions, which we'll learn in the next chapter, subtracting out exemptions that we learned, I believe, back in chapter 2, to get our taxable income that includes the qualified dividends and capital gains. Now in the next line is the income tax on that taxable income. Keeping in mind the long-term capital gains and qualified dividends, possibly even the unrecaptured section 1250 depreciation and the collectible gains are going to be taxed at lower rates. So what we're going to see is some worksheets to calculate all of that different tax rates. But then the total tax will be reported here in line 44, the income tax for the year. Within the past few years, there's been some other additional taxes that we have to report on our 1040 form, including these two forms here. So if you've been listening into the news, there's always news about trying to repeal Obamacare or the Affordable Care Act, and that health insurance is partially funded through additional taxes that are calculated here on this form. One for additional Medicare tax and one for additional what we call net investment income tax that we learn about here in chapter 5. So we'll take a look at this form 8960 near the end of this slideshow. Here's that business sale of equipment or a business building, yeah? And it's not treated as a capital gain, but it could be treated as ordinary income. Let's see right here. Ordinary income, not capital gain income. So the total of that ordinary income or even possible loss goes back to that form 1040 line 14. Not line 13 capital gain, but other gain, line 14 ordinary gain or loss, not capital gain or loss. But some of the business property, and we'll learn this I guess in a future chapter, could be treated as a capital gain or loss. Here, this number, really a capital gain, not a loss, and reported through the Schedule D before reporting it or grouping it on the 1040 form. This is page 1, and here is the second page calculating something called recapture, depreciation recapture. Here's Schedule D. This is the example in our chapter 5 using Virgil Brady's transactions, and we divide it up into short-term and long-term, grouping the gains and losses for each one. Notice though that you don't see the detail of the sales. What you see here is different situations first reported on this form. Let me zoom in here. A form called 8949 with a situation A, B, and C. This is all short term. And then further down, for long term, you kind of have a mirror image for three different situations again. Situations D would match up with A above, E would match up with B above, F would match with C above. This is long term, and up there is the short term. So the netting of the short term would be this amount here, looks like a loss. Netting out of the long term looks like just gain, so you just have a gain here. So here is a net short-term capital gain, a loss, negative, and here is a net long-term capital gain. And you would combine both of these two subtotals at the top of the next page here. And this is what is reported back on the 1040 form line 13. Keeping in mind that the gain or losses that are combined in here could be taxed at different rates, like at the 28% rate if it includes collectible gains, or that section 1202 stock gains. Or here could be taxed at a maximum rate of 25% if included in here is unrecaptured section 1250 gains from the sale of business assets that were depreciated. You don't see the calculation of those things here on this screen, but it's done on worksheets. Now, if you have a loss over here, up to $3,000 of the losses can be deducted back on the 1040 form, and any excess loss can be reported on next year's Schedule D. Let's go back up to that schedule, page 1. So here is short-term losses carried over from previous years. Here's long-term capital losses carried over from previous years, combined with the current year's gains or losses. And you can continue carrying over unused losses up to the last tax return for this individual, for the year they pass away. After that, the loss, if any is unused, will expire. So that's Schedule D. Let's take a look at the details for this 8949 form that feeds into Schedule D. 8949, again using the Brady example in our Chapter 5 textbook. So again, we have short term. This is page 1 of the 8949. On the back side of this form would be long term. And like we saw in Schedule D, it would be A, B, or C. Here it's A is checked off, which is short term, and reported to the taxpayer are all the sales for on a form called 1099B coming from a broker. In other words, when you check off this A, only A transactions can be reported now on this list. So if you have a B situation, you got to use another 8949 form. So reported on this 1099 form would be from the broker, this share sold with the broker that was bought on this date, sold with the broker on this date for this price, and originally bought at this cost. So the difference between the sales price and the adjusted basis would be the gain or the loss. And you're combining all of this short-term gains and losses for situation A to get a grand total. So this is what you see back on the Schedule D, this line right here for category A. Now the A means that this 1099B form shows both the sales price and the cost basis of what's being sold here. If situation B is checked off, that means the 1099B only shows the sales price and not the cost basis. Or situation C is checked off, that means no 1099 was issued for this sale. Here's the backside of the 8949 for long term. Again, with a 1099B showing all of the information, or 1099B only showing the sales information and no cost information, or no 1099 that was issued. Again, here's all the detail, combining the long-term gains and losses for either A, B, or C, whatever you checked off here, to get a grand total that shows up back on the Schedule D. So this is where you see detail for sales transactions on this 8949. Here's a 1099B that was issued by this broker to this taxpayer, showing the date that it was purchased by the taxpayer. Date sold should be sometime during 2017. The sales price and the cost basis, and whether that gain is long or short term. Another tax form that reports sales. This is typically issued by an escrow company for the sale of real estate. And here's the date it was sold, and here's how much. It wouldn't show cost amounts on this 1099S form. We saw back in chapter 3, qualified dividends. These get taxed just like the long-term capital gains at those low rates, 0, 15, or 20%. Now to do all the detailed calculations, what you see is a worksheet kept by the taxpayer, not filed with the tax return. So information is coming from the tax form. So here's the taxable income of the taxpayer that includes the qualified dividends and the net capital gains in this number. And we learned that qualified dividends, that's this line back on the 1040, 9B, and the long-term capital gains, that's this number coming from the Schedule D, are going to be taxed at the lower rate. So this number here is going to be taxed at lower rates than the other income. Keeping in mind this number is inside here, so we back it out. So this other income will be taxed at the regular tax rates, whereas the 13,600 will be taxed at lower rates. And depending upon whether the taxable income is below a certain level, meaning at the 10 or 15%, the qualified dividends and long-term capital gains will be taxed at, let me see if I can zoom in here, will be taxed at 0. I can't write when I'm zooming in, the 0 rate. Or if you exceed these rates based upon the taxable income exceeds these levels based upon the filing status, they'll be taxed at 15% here. And if you exceed these high levels, the qualified dividends and long-term capital gains will be taxed at 20%. So you add up all these different tax amounts, including the tax on the rest of the income here in line 24. That's the taxable income less the qualified dividends and capital gains. And this is, you add them all up, and here's the total tax for the year. Now, if all the income is taxed at regular rates, here would be the tax. So the difference is really the savings being taxed at the lower rates. This is the actual tax again, and here is the difference is the savings, yeah, taxed at lower rates. Now, if you have collectible gains and the unrecaptured Section 1250 gains, you probably have to use another schedule, another worksheet to figure out your income, because now built into this schedule somewhere would be, here's the 28% and the 25%. I'm not sure why, but the IRS says just to keep this for your records. You don't file this with your tax return, unlike all of those other schedules and forms we've seen. I think a couple more forms here, one more form. So here is the additional tax to help pay for the Affordable Care Act. So if you have interest income, dividend income, annuity, rental income, and capital gain income that we've talked about here in chapter 5, not only is it subject to income taxes, again, all possibly at all those different rates, but now you're going to be subject to possibly the net investment income tax if your total income, I believe it's adjusted gross income, exceeds a certain level. I believe it's like a couple $100,000 based upon your filing status. And all of this income, when you total it, may be subject to a rate, let me zoom in here, of an additional 3.8%. Again, we call this the net investment income tax, in addition to the regular income tax we've been calculating. I believe one of the homework problems or one of the dynamic study module problems may have, you have to calculate this 3.8% on the investment income. One more form. I think this is the last form. We've seen a Schedule D before, but it was for a 1040 individual tax return. The 1120 form is for corporate taxpayers. And just like individuals, you group the gains by short term and long term. But when you take a grand total down here somewhere of the gain, all of the gain is taxed at the regular rates. So you just report this back on the regular 1120 tax form for the corporation. Now, if you have a loss, if you read the wording down here, note if losses exceed gains, it says see instructions. There is no deduction against other income for capital losses of a corporation. Unlike individuals where you have that $3,000 per year to offset ordinary income, corporations don't have that. But what corporations can do is to take this capital losses and carry it back 3 years ago. So let's look at the year here. We're looking at 2016. So let's say we have a loss down here. Well, you don't even report the loss. It's just calculated. So you can use this loss and carry it back to 2013 to offset any capital gains there and get back a refund if you had paid taxes on those gains. And if you have still extra losses left over, then you carry it over to 2014 and 2015. Again, the loss is originating here in the current year 2016. So after carrying it back 3 years, the oldest year first, then you can start carrying it forward to 2017, 2018. It will only go up to a total of 5 years after the current year. So it looks like the last year that you can claim any unused losses for 2016 is 2021. And if you're not using the loss here for 2016 by 2021, the loss will expire. This is not like the individual where it'll expire when the taxpayer dies. The corporate capital losses you carry back 3 years, and you can carry forward 5 years after offsetting gains for the current year. Right, a couple more forms. We've been talking about income taxes in our class, but if you want to learn gift taxes, you gotta prepare eventually maybe a gift tax form, Form 709. And you do this annually with the income tax return at the same time for gifts made during the current year. Even if you don't pay any gift taxes because of the so-called unified exemption of 5.5 million, you still may have to file this form. It's about a half dozen pages. And if our taxpayer dies, remember that's a decedent, you may need to file a Form 706, a once in a lifetime, really after lifetime tax return that could go on for a couple dozen different pages. And even if there is no estate tax due, a form possibly should be filed to document the step up in basis for people who are inheriting the property. So now when they sell the property, they get a higher cost basis they can deduct, reducing the amount of gain they're going to need to report and pay taxes on. So as an income tax preparer, if you plan to be one, you should probably maybe start learning also how to prepare estate tax returns, estate tax rules, and gift taxes. Here at UH West Oahu, I've seen in the catalog a course called Business 495, Gift and Estate Taxation, but I've never seen it being offered in over the couple dozen years I've been teaching at Fort West Oahu as a lecturer. Most times a estate and gift tax course is taught at the graduate level. I've seen it offered a few times, maybe once or every other year on the Manoa campus, but not at the UH West Oahu campus. Okay, that's it. If you have questions, make sure you email me and I'll share your question and my response to the class with the class.